Welcome to Beyond Bitcoin, a podcast about all things digital assets, the global communities they are creating, the generations that are using and investing in them, and the challenges faced by the nations that are seeking to regulate them. The content of this program is not to be taken as investment advice. My name is Derek Graham. I'm the CEO of Portal Asset Management, and my co-host is Nitin Gower, Director of IBM Digital Assets and CTO of Portal. Good morning, good afternoon, good evening, wherever you are in the world. Welcome along to Beyond Bitcoin. Today we have a great show because we've got a special guest with us today, Corey Segal, that's come to join us. Hello, Corey.
Hey, how's it going, guys? Hey, Nitin. Hey, Derek. Great to be here.
Hey, Corey.
Appreciate being on.
Hey, Derek.
And of course, we've got Nitin, our friend and colleague, based over in Austin, Texas. How are you going today, Nitin?
Hey, Derek. Glad to be here. Corey, really good to have you on the show. Looking forward to this amazing chat.
So to say that we're not going to talk about volatility is to say we're not going to talk about an elephant that's sitting over in the corner of that room, because guess what? It's another massively volatile market, isn't it? Fancy that.
It's been a last interesting few weeks, both in terms of the narratives that you hear from the regulators, but at the same time, I think the ups and downs in the market, the USDT and UST and all that's in news is only making it interesting. But at the same time, to me, I'm taking notes in terms of lessons learned. And I think, Derek, if you recall, we did have exactly this conversation a few months back in terms of probability and possibility of having an algorithmic, a stable coin and what it means for the industry. So I think, to me, this is an exciting time to learn. But maybe not as exciting from an investment perspective, I think.
Well, interesting enough, in times of volatility, there are always opportunities. And as a side, 7 out of the 11 funds that the Portal Digital Fund has invested in have generated a profit so far this month. And so some of them have been shorting UST and Terra Luna, topic in hand, algorithm-generated stablecoins. So there's always opportunities in a marketplace. But what I really wanted to get across is that, the marketplace is extraordinary in the fact that it's down 66% in the last 12 months. That's the CCI 30 is down 66% in the last 12 months. This is a very large amount, from 33,000 peak down to 10,900. And so you'd look at that and go, well, why would you invest in this space? And I want to just give a little bit of background. Last week I wasn't here. I listened to your show, Nitin. Fantastic. Thanks very much. It was just awesome. And I was meeting with institutional investors and platforms, and we had 25 meetings in Sydney and Melbourne last week. And these institutional investors didn't raise the topic of the volatility of the market at all. And that's number one. And number two is that we wouldn't have been able to meet these institutional investors 2 years ago because they wouldn't have been interested. So I think despite the volatility in this space, there's a continuity now and an admittance that this space is here to stay and will grow. And that is superb that we're seeing that. Platforms, large retail and wholesale platforms that are interested in their investors being able to get exposure to the space. And why not? Because when you look at it, there's nothing but good news happening in the space. Some $41 billion of VC money's been put into it in the last, 15 months that's gone into this space. That's a huge amount into this area that where you don't, it's not a 7-year program to develop an antibiotic. This is a 2-year program you can develop some of these blockchain solutions. And also, of course, the user base is tripling on an annual basis in an exponential curve and adoption of a new technology. And so we're still really bullish about this space, naturally. And despite the volatility, we see that just as opportunity. I know that sounds a little cliched, but it's a fact. But amongst all of this volatility, there is continuity. And the growth in these marketplaces is what we really want to talk about today with Corey Segal. And again, thanks for joining us, Corey. And maybe you'd introduce what Vitello does and set some context to what we're about to go through in discussion of these token sectors.
Sure. Thanks for having me again. And so what does Vertalo do? Vertalo connects, enables the digital asset ecosystem. And I'll go over in a little bit here what falls underneath the digital asset category, because it encompasses a lot of different aspects. And so at the end of the day, we help people raise money on our platform, our technology. Think of us as almost like a Shopify for private markets. So we operate in the private market space and we help issuers, broker dealers, people raising money, want to syndicate as well around that, be able to raise capital efficiently, reduce the friction in terms of like KYC, AML. If you have to do accreditation, we support that as well. And get to the point where you get to fit payments and funding, and finally, DocuSign your subscription agreement, and you're good to go in terms of that. And then we get to the secondary liquidity. So after a certain point in time, you may be rich on paper, but if you don't know, traditionally in the private market space, it's very illiquid. And it's hard to actually sell your shares unless you get acquired or you go IPO. So in between that state, how do I actually, if I want to, reduce my position for whatever reason, paying for a college education for my kid, maybe I want to invest in some newer startups. You're able to do that through secondary liquidity through what we call these ATSs, these licensed SEC broker dealer licensed and FINRA licensed alternative trading systems, AKA secondary exchanges in the private market space. So it allows you, whether it's T0 or OPM or Texture Capital, they allow you to get there. So what we do is we connect and enable that entire ecosystem. Think of us almost like a nucleus of the solar system, in the sense where we connect with all these different partners, give you optionality. Maybe you want to do a KYC with one partner versus another. Maybe you want to go ahead and get funding from one partner versus other. And there's various reasons to do that. And then finally, on the ATS side, maybe you want to list on T0 or Templum. Some of these ATSs only handle what we call tokenized assets. Some actually handle digital assets. And the SEC, for their own reasons, have decided to keep those two separate with the licensing. So that's kind of what Vertalo does. We have people that use our platform underneath, just like a Plaid, just like a Shopify, build on top of it. We're API first. Or they can use our contextual onboarding application, their choice. And so we have use cases like Roofstock, who is a big, single family residential company, 4 billion plus in assets, connecting to us, allowing us to manage their cap tables, getting to either DeFi solutions or secondary liquidity, to like My Racehorse. So you right now can go out there to My Racehorse and for $50 buy a fractional ownership of a horse. And these horses compete in all sorts of races, including the Kentucky Derby. 1 year, actually, one of the horses won. And you, because you're an equity owner in that horse, get a distribution from that prize pool that they win. So this is an example of a couple things. There's collectibles. There's obviously a lot of housing that gets fractionalized and tokenized. So, as we get into the tokenization here, be happy to talk a little bit more about that.
Wow, this sounds so exciting. I mean, Corey, I think we met at the DAS conference last year, which is coming up next week in Austin, Texas, which is where we both live. And so looking forward to meeting you and the ecosystem players there. But I think what you just described is something we have been talking in the industry for quite some time, which is fractionalization. And what I have termed back in the day as instance economy is ability for you to have an ownership in an instance of any asset class per se, whether it's real estate, and as the example that you mentioned. So I think to me, it's not just simply tokenizing the world as everyone's been talking about, is hey, let's go and tokenize the traditional asset classes. You have taken the step in building the framework, the infrastructure that facilitates some of the fundamental tenets of blockchain: trade, trust, ownership. Is facilitating liquidity, facilitating ability for people to not just do capital formation, creating secondary markets, and the entire ecosystem revolving around it. And I believe last time when I was at the DAS conference, there was a lot of energy and buzz about doing all kinds of things, whether it's taking, and financing an airplane and tokenizing that and having fractional ownership in that, respect. And then you had art and painting, and ATSs were all over the place. And the panel talked about a lot of stuff. Help our audiences get the gravity of this. We've always compared 471 trillion of traditional asset classes. And in one of those sessions, we talked about a potential value of $2 quadrillion, which is basically trillion of $1 trillion mark. Help us understand the gravity of this potentiality of the markets, not just capital formation, but ability for us to create fractionalized assets, ability for us to be able to digitally move these things, which historically was not possible.
Yeah, so a couple of myths and truth here. So right now, the SEC does not recognize public blockchains. They do recognize private or permissioned, actually, blockchains. So one of the things that we're doing is trying to help to convince them that a blockchain is a better immutable ledger than a Postgres database. So that's one thing we're doing here. But regards to your actual, question here, there's a lot of things you can do. So you can fractionalize today via just digital shares. So a lot of our clients, for example, will take a house and turn it into a little LLC, put 1,000 shares out there and allow you and your 4 friends essentially to buy a quarter of the shares each and basically co-own the home. There's those components. Same thing with digital collectibles. So you can fractionalize via creating an LLC on these different asset classes and these assets and sell those digital shares, or you could tokenize. One of the reasons why you want to tokenize, future proofing is one big reason. Another is just from a marketing perspective, everyone likes the idea of having a tokenized asset. You're able to put this, if you want to, you can whitelist it and stick it into your wallet, like whether a MetaMask wallet or a Trust wallet. Now, these are all securities, however. So within the security protocol, we have to program certain things around a clawback. We have to be able to, you can't lose a security like you can a Bitcoin. And we need a little more detail around that. I have to rehypothecate if you die or you pass on and there's a trust that and we're forced to transfer. Vertalo is a licensed SEC transfer agent. We're able to transfer that to the appropriate people. So as far as protocols go, and if you look at, we get into a little bit more about what security tokens are, and that's just one asset category underneath digital assets, and there's others. You're looking at, sort of the 1400 category, the 14000, the 1404, the 1450, the 462. There's a whole bunch of variations of this, but essentially they allow you to meet SEC compliance, in this case, in the United States, or any jurisdictional compliance, but be able to put together a good control location aspects to this and be able to reproduce those security tokens. And so when you look at tokenizing assets that are considered securities, whether it's homes or fraction, when you talk about fractional, by the way, even a fractional NFT, that really starts to bridge the gap to securities. And so I kind of, when you start looking at these sort of things around NFTs that are fractionalized, you're going to be hearing a lot from the SEC and from the regulators around, guys, this is not a bearer asset. This really is getting into a securities realm. There are going to be NFTs that are going to be strictly, consumable bearer assets, no problem. Or they might be things around, for example, they might be around membership programs. A lot of things like even the Bored Yacht. Everyone knows about the Bored Yacht Ape Club, right? The Bored Apes. That really is essentially a very elite membership club. At the end of the day, you have this NFT, and it provides access to all sorts of parties, events, to a bunch of stars right now. Now, whether or not you like that from a traditional standpoint or not, it's interesting. But nonetheless, I can go on and on here, but I'll stop there as far as kind of an idea of tokenization. But tokenization is definitely going to be a huge play. It's definitely a future proof right now. And I think with some of the things you can do around royalties, and you can program all sorts of restrictions in there from a securities perspective. You can program things around access to events or to certain files. I think tokenization is going to have a huge future.
So we certainly do too. Hey, Corey and Nitin, let's just get some clarification here. This whole world, that's blurry world between a security token and a non-fungible token, seems to be a question I'm getting asked on a regular basis. Really, what's the difference? Right. And certainly the non-fungible token, I've often heard argued is that it's a community builder, and it provides benefits around that rather than just transfer of assets. But it does transfer an asset. So can you help us out here? What is the difference between a security token and a non-fungible token?
Yeah, so let me just go at a higher level. It's just general categories or like use cases of tokens. All right. You have the traditional Bitcoin, Ethereum, we call it cryptocurrencies. And these really are currencies at what we call the layer 1 solution, the blockchain level, where they're actually rewarding validators or miners for performing essentially an important function to make sure the ledger is intact and whole. So those are the cryptocurrencies that you're used to seeing, Litecoin, Bitcoin, Ethereum, and so forth. If you look at other like Solana on Solana, or Cardano on Cardano on blockchain, or Tezos on the Tezos blockchain. Then you get into what's called utility tokens. These are typically, people hear of ERC20. The Binance Smart Chain has basically a BCS version of that as well. And these sort of tokens are used for what we call layer 2 solutions. It used to be called decentralized applications. Now you can probably call them Web3 applications. And you get to things like everything from like MakerDAO, which is more of a stable coin, to a utility token for like a rewards program or a loyalty program. So you have these sort of concepts where you basically print your own set pool of tokens that you're using for a utility or service sort of purpose. Then you get into what's called, I already mentioned stable coins, but really stable coins, the difference between that one, even though it's on the ERC20, is it's tied usually backed by an asset like a dollar or gold or oil. And so we look at stable coins, they're usually backed by things. Additionally, you can have what's called algorithm stable coins like Tether, where not even Tether, sorry. Tether's supposed to be backed by a dollar, but that's a separate discussion there. But if you look at like MakerDAO, that's actually an algorithm coin where there's a formula around that. And then finally, you have non-fungible tokens, which really are unique individual tokens. These are things where every single one is its own little like sort of footprint and fingerprint. And they're all distinct and unique, and there's a lot of purposes for that. So when you look at NFTs, you want it because you want to have a distinct individual entity, object, asset that's very different from any other asset. On the other hand, when you have a concept of saying, hey, I have Amazing Spider-Man #1. I'm going to turn that into NFT, but you know what? It's $100,000. Why don't we try to sell this in a fractional way where we have, 1,000 people be able to buy this, at $1,000 a pop, or whatever the case may be, versus actually trying to buy this myself. As soon as you fractionalize it, you're now getting into the realm of securities. So now you have this non-fungible token, which is a unique asset that also happens to be security. And unfortunately, most of these non-fungible tokens are under the ERC20 standard, which doesn't allow for provisions around clawback, ability to add restrictions if necessary, ability to reproduce. ERC20, you can lose. And so because of that general starting protocol does not work. So you have to go to other protocols that are more security token oriented, and security token oriented can still be a non-fungible token, but they're very much, from a parent standpoint, security tokens. And they're super important around that, because you have to be able to do these sort of, how these protocols built into where you're able to do these functions based on the jurisdiction regulation that exists today. So non-fungible tokens are ERC20. You can lose them. I can lose my board Yacht Ape if I put it in my own non-custodial wallet and I happen to lose access to it. Not very good. I lose my $500,000 ape. It sucks. It really does, because some of these apes are that expensive these days, and that's pretty good. But in addition to that, you also have these security tokens, which you cannot lose. They're not bearer assets, and therefore there's no risk around you actually losing them, even in a non-custodial wallet, because they can be rehypothecated, they can be reproduced, and these securities can, essentially be around forever. And you have a third party agent that tends to help you do this, or potentially a blockchain that acts as that agent.
Wow. Yeah. So let me ask you one thing. I think last week I had a colleague of mine who's data scientist, and we've been actually framing a lot in terms of how do we do analysis, how do we make sense of this craziness that's all around us, this velocity and veracity of data that's coming through. And we talked about pricing, and pricing, as you know, Corey, is a really important part in all financial markets. Price is what you pay, value is what you get, and then there's a market in between those two sort of constructs. And there's one reason why I think many of the regulators are looking into saying, how do you price these things, how much data is available, and that inspired me to think about how do we stump a data scientist, and what I'm calling as metaversical anomalies is how the hell do you price NFTs, which is very subjective, very personal, and in many cases, if you look at what you're doing as Vertalo, which is a transfer agent and working with ATSs, is trying to bring this whole notion of private markets and tokenizing this entire infrastructure and creating a market structure around it. Love to get your perspective on, I get what we're doing with real estate, right? There's a LLC, there's an SPV that you create, and SPV then becomes a front in dealing with the regulated world, and then SPV then handles the fractionalization and dealing with liquidation and things like that. So you have a structure in place to do that. You have something similar with, I'm assuming, racehorse, story that you mentioned. But when you look into NFTs, can I bring an NFT and go through your system, whether it's ERC20, ERC741, and other standards that are deemed to define, and those are technical standards, but can I bring that to a private market? Can I bring NFT? And if I can bring my NFT and go through that to be able to raise money through that NFT as a collateral, for instance, what is how do I go about doing that?
Yeah, so the non-fungible token, essentially you do got to establish a legal entity behind that non-fungible token asset. And you do digitize the shares or tokenize the shares. And once that's done, you can have all the other programming stuff into it. You can have, paying royalties and whatnot. Now you got to be careful, and I won't go into the amount of on-chain expense that goes on, some things around putting some of these contracts that get very heavily weighted versus doing what we do at Vertalo, for example, is a multi-suite of contracts where we have a method, we call a method contract, a lightweight contract on chain that refers to off chain. So you can also do upgrades. One of the problems with an NFT is, let's say I have a 20% royalty and I want to now downgrade it to 15%. Guess what? You can't do that traditionally because you have to burn all those NFTs and reproduce another NFTs under a new smart contract, right? But with an upgradable concept, you're actually able to change that off chain and be on things that make sense, that you have control as the artist in this case, and be able to go from a 15 to 20% royalty down to say 10% for whatever reason you want to do that. And so you have those sort of aspects. But when you get into the securities realm, like I said, you really got to look at, and a lot of people think, well, do I need a tokenizer or do I need to just create digital shares? And the answer is digital shares. Essentially, you gotta treat them just like stock, and the preferred tokens, preferred shares of class A, class B. You do a traditional raise via a fund, either a Reg A or Reg CF for a non-credited sort of democratization aspect to this. Yeah. So when you look at, for example, one of our clients, which was Mythic Markets, that did a lot of collectibles, they turn these things into LLCs under a big Reg A or Reg CF sort of umbrella fund, and allow people to buy and sell these things, through a secondary market. And so that's what you would do on our platform. You go through a broker dealer to make that happen. We would act as a vehicle to onboard all your investors to buy those shares and those fractional assets. It's part of your marketplace. A good example of this would be Rally. Have you ever heard of Rally? Yeah. It's a huge platform. They are licensed by one of our clients, Dalmore, underneath, and they do a lot of tokenization. Gary does a guy named Gary does a bunch of this stuff, and so. And then you can do secondary liquidity. You can list this onto a T0, or you can list it onto like an OpenSea. The fact is, Nitin and Derek, the OpenSeas of this world, the wearables of this world, these big marketplaces, they're, in my personal view, this is just my point of view, and based on what we're hearing, they're going to be forced to become broker dealers. I mean, Christie's is a broker dealer, Sotheby's is a broker dealer. They're going to have to be at some point, just because of, you've heard of some of the regulatory issues around the listings and the non-qualifications, and you get into the whole thing around people doing rug pulls around some of these listings because they're not being validated, these projects, or the projects are being manipulated internally or externally. And so, but getting back to the NFT question you had, Nitin, absolutely, we can support that. You can support that under a securities umbrella. You can support that under a non-securities umbrella. So some NFTs, if you're creating an NFT just for someone to buy as a patron and consume and have on their wall, and that's the quote, the public intent, it's not a security in general, you'll be all right. But as soon as you start fractionalizing, or as soon as you start programming these NFTs to have a distribution or a payback for owning it, then you're getting into the concept of investment. It's very clearly an investment, and as soon as publicly known as investment, in the way you sort of structured your NFT, that's where you're going to get in the gray area of well, not even let's say gray area. It's going to be security, in my opinion. Again, I'm not a legal security lawyer. We happen to have one though as a co-founder on our company, who was a former SEC regulator. So. And we do have our ears to the regulation, and we have a good idea of the direction things are going in.
I think Corey. Yeah.
Sorry,
go ahead, Derek.
Look, I was just saying that. Go for it.
I'd just like to remind that this is, again, not investment advice. This is just for conversational purposes to audiences. But one thing I'll say, Corey, as spoken fun at all blockchain professionals, every single blockchain professional is a lawyer, is an economist, is a technologist, and a business development guy all at the same time. You begin to see these conversations having an overlapping function in any chats that I've been through. So kudos to you for that. Sorry, Derek, it's back to you, mate.
This whole area, it's interesting because we're dancing around what an NFT is. We're dancing around what a security token is. I just thought, for a Bored Ape, you could wrap a Bored Ape NFT into a wrap and create a security token out of it, fractionate it and sell it. I mean, it's just a blur, isn't it, of the things that you can do wrapped around these various assets. The question I've got, though, is, of course, is that what we're doing at the moment is we're dancing around these 1930-odd security SEC regulations. And they're ancient and they're not designed for this kind of world. And so we're trying to accommodate that. And you're trying to on-ramp traditional finance into that space too. Do you think the regulators are going to get to a point where they start regulating this space with a view of the fact that future generations will have a wallet loaded with NFTs and security tokens and currencies, the assets of their family, all sorts of things sitting in it. And they don't necessarily have to be defined as they were in the past. Do you think they're going to be able to go from that fixed definition of their view of a security asset to maybe a new definition in the future? Or do you think they're just going to try and bolt all of this into a traditional way of looking at assets?
That's a really good question. So there's a couple of regulatory bodies, at least in the United States, and the IRS wants their tax money, right? And wherever value is created, and as value gets created to the metaverse and virtual and in these non-fungible tokens and these digital asset realm, as value transfers and a chunk of wealth starts happening in that sphere of influence, they're going to want a tax on that as transactions happen. And so you got the IRS looking at it from that perspective, and then you got it from a regulatory perspective on the SEC's perspective. And their quoted intent is to protect the investor. I do like the fact that at least the United States with the Jobs Act, they allow for crowdfunding and Reg A Plus to allow for unaccredited investors to start investing. And so this allows you to democratize access to financial kind of wealth building, because as most people know or don't know, earning paychecks is good. Building assets is where wealth actually gets occurred and generational wealth starts to happen. So allowing that access is super important. As far as the 1933, 1934 laws around and how we test and securities, I think there'll be some adaptation, but in general, I think they're going to hold to wanting to ensure that people are known that are issuing these securities, KYC, AML, some sort of format, so that you don't have rug pulls, you don't have fly-by-night projects, you don't have people doing a lot of marketing hype only to whether influencers or not, whether Mayweather or not, intentionally or not intentionally being used to sell these sort of raise money and sell these securities only for the project to only be there really to die off and make money on that sort of scenario. So you have that component, and then you have people, at least the intent, again, right or wrong, and that'll update people's opinions on what side of the aisle they're on around the SEC and regulation. But you have the intent also to, quote, protect the investor from not losing the security, ensuring that there's certain protocols and third parties in place to make sure that the issuer, traditionally the issuer who issues, should not have the access to there's conflict of interest between the issuer and necessarily the investor. They potentially have different interests down the line. So that's why you have a third party like a transfer agent or a custodian try to help sort of like manage that interest for the investor and manage the interest for the issuer, but not have some sort of fox guarding the hen house there. So that's a lot of reasons why transfer agents first got about. And transfer agents historically were, back in the day, you had paper in a freaking custodial vault. right? And so that's why, you had that sort of concept around custodianship, and transfer agents literally moved paper around and kept books and records, right? But with a digital version of this, the idea behind self-custody and things of that nature now exist, to where in the digital realm, things are going to change. But getting back to your question, I do think there's going to be some adaptations around that. I know that the SEC is looking at the digital transfer agents that are in this space and what we're doing, and using that to help hopefully formulate new regulation.
Yeah.
As you know, new regulation doesn't happen on a dime. It can take years, sometimes decades to change. But I do think that they're going to have to at least react and sort of contain the Wild West that's going on now to some extent.
Yes.
I just hope they don't over engineer that, where they really restrict the innovation. And so one of the things that we're trying to do is help them understand the innovation, yet also the regulation, and sort of bridge that gap.
Oh, fantastic. So that begs another question, though. I think you mentioned the legacy of this paperwork and custody of this paperwork, and then transferring this paperwork. If I look at Coinbase, right, and I think Coinbase presents an interesting dichotomy where it's irony of all ironies that in a decentralized world you have a centralized structure that does everything. Coinbase is sort of a prime brokerage. They're a custodian. They provide banking services. I can do all kinds of interesting things. They also provide, some elements and some characteristics of what CFTC regulates from a commodities perspective. So they're sort of collapsed into a single entity that's providing very different financial services. So the question that I have for you, as you described the functioning of what you do, Corey, in terms of digitizing and tokenizing the markets and the assets and working with ATSs, help me understand the new function of this entity. If transfer agents back in the day had a purpose because of the fact that they were involved in transferring these assets from let's say custodians to the market participants, what is the role now with tokenized assets? Why can't we collapse the ATSs and TAs into one entity, which does the function of issuance of an asset, governance of an asset class, and then servicing that asset, and eventually going after in using an ATS as a vehicle to generate liquidity in the system? I'd love to get your thoughts on that, since you're so close to it.
Yeah, there are some entities like T0 that have done things like are now self-clearing.
Yeah.
And they're an ATS, but there are certain regulations that require a TA. For example, a Reg A and a Reg CF, all the crowdfunding, they require legally that you have a transfer agent involved in those cases. Also, just from a risk standpoint, because the way the SEC audits and FINRA looks at you, it's way better to have a TA involved in terms of optics. And to avoid, honestly, having a TA is a lot easier than having to avoid all the auditing that the SEC is going to do on you by not having one. So it's just better in general. So all the ATSs that we are dealing with are saying we are going to have a licensed transfer agent involved with our trades. And again, those are just trades, and also with the transfers. And there's a difference between trading and transfer. Trading is the buying, selling of shares, order matching, and whatnot. Transfer is when you have to actually move an asset from one person to another due to death or due to a court order. Sometimes a lot of assets are lost, and they, especially in the housing industry where they get abandoned, and you have to do something with that, as cheap and so forth. So there's a lot of aspects that you have to do around officially transferring that. So, well, at least at Vertalo, we're more than just a TA. TA actually is just a form of SEC role, but it's that connecting and enabling. It's allowing that fluidity instead of having to connect to a like DocuSign and signing a document and having to fill out all the information there, then going to a payment provider and then doing payment over there. And then this and this. Why not have a single 7-step flow where you can easily onboard, get through that process quickly, and then integrating with these ATSs is not necessarily an easy thing to do as well. So because if you're using a platform that's already connected to 7 or 8 ATSs, and you have the optionality to choose which one without having to integrate individually. Same reason why people use wallets today, that have thousands of coins and thousands of blockchains attached to it versus doing their own wallet. So it's basically just it's very time consuming. A lot of the companies don't want to be involved as a technology company, right? There's a reason why people don't build their own AWS cloud server storage service, right? They use AWS. So this infrastructure is super important. So think of us as almost like a transfer agent and a connecting enabled infrastructure. Like I said, like a Shopify, to really help the ecosystem be able to help support all these different use cases, whether they're NFTs, whether or not they're actual other non-fungible assets. There are clients, for example, that are like, for example, patents. Patents are typically a liquid asset. Now you can make those patents liquid by putting them onto a platform, digitizing them, and allowing them to go to a secondary exchange where you can actually you go from a garage sale mode of patents, trying to sell patents you're not interested in anymore, or you want to get a lot of value out early, to now actually being able to sell them quickly. Same thing with future contracts on NFL stars and NBAs. We have clients that are wanting to sell a contract of a college pro that's expected to do very well, and they'll give that college graduate millions of dollars now for 20% equity in their future earnings and as they go pro. So there's
you would do that on a security token, would you?
You can. Yep.
All
exactly.
right. So look, I've got to say that, the further down we get this conversation, the juicier it gets, because the concept of being able to, sell and securitize your university fees in advance because someone believes in you and you're competent. The concept of being able to, fractionate a horse, which is a totally brilliant idea. And I want the first $50. I want the nose of the horse for the first $50. So each one of these things, we often sort of, Nitin, when you and I talk about it, we sort of wave our hand and go, and by the way, you can do this. But there's a lot of structural reality to go from a physicality world to a world of digital assets. And that's clearly, what Vitello is doing is part of that. Part of that digitizing is part of the legalities that go with how do you tokenize an asset? What do you determine as an NFT? What do you determine as a tokenized asset? It's fascinating, and it's going to be an area that I think is going to grow enormously. And so I asked this, Corey, how do our listeners maybe get in touch with you if they want to, and talk with them about maybe their ideas of what they might want to securitize or what they might want to create an NFT out of? What's the easiest way of getting in contact with you?
And before you answer that, Corey, tell us also about, is there a digital streaming option with the DAS conference, which is very intimate and has the right sort of audiences, as I have learned a lot during my participation in these events. Please tell us more about that as well.
Yeah, so the Digital Asset Conference this year is a user conference, and we have, for example, the largest governance broker dealer, the DTC there, which literally processes and authorizes quadrillions of dollars. Every broker dealer, every asset in the United States passes through their hands. New York Stock Exchange is going to be there. Goldman Sachs, Chase, State Street, go figure. Amongst a lot, Alto IRA, it's very interesting that you can actually take a self-directed IRA and invest in both crypto and non-crypto assets, to DeFi platforms, to actually, we're having someone that's running for Congress as well, and Bruce Fenton, of Satoshi Roundtable. So he bridges both, crypto maximist as well as with securities and kind of how those combine. So it's going to be really fun. We have Spasmatics coming out on being playing. They're kind of a retro kind of Devo band, and that's been playing on Thursday night. But the conference is really great because it really, it's going to show progress and results. So you hear a lot of talk and hype, even like maybe on this conversation and this podcast now, but we're actually showing actual results where from first dollar raised to secondary liquidity. And we have real issuers who raised money and now are on a secondary exchange, and being able to present that.
So Corey, how do they find out about that particular conference? Is there a place to go to be able to sign up to that? Because I think that's what they want to do. And then we need to wrap up, because this is one of those things where we can talk about for hours. But please tell us, how do they find out about that conference?
Yeah, if they just Google Digital Assets and Securities Conference, Austin, Texas, that's the easiest way to do it, and you'll see it there, and just let's look at it. And happy to come. If you contact me directly, I can get you some discounted tickets, purely because I'm a guest on your podcast here. Yep.
Thank you.
So yeah, so happy
Thank
to
you
do
very
that.
much. Corey Segal, and
you
can also find that you'll find you on LinkedIn too, can't they?
LinkedIn, they can find me on Twitter. I often visit Clubhouse and some of the prominent rooms around digital assets and sustainability and things of that nature. So yeah,
terrific.
And you can email me as well at corey.segal@vertalo.com.
Hey, thank you very much. That's terrific. Look, fascinating journey. Thank you so much for coming on board. And, we look forward to catching up again, maybe along the way. I think your space is going to be enormously busy in the next decade, because the process of digitizing physical assets is going to be enormous. I would call possibly it's the biggest on-ramp we've got close to into this space. Thank you so much for sharing your time. And of course, Nitin, always great to see you, and look forward to seeing you next week.
Derek. Likewise. And Corey, again, thanks so much for your time and expertise. And I'll see you next week. Bye.
Bye for now.
Thank you, Nitin. See you next week. Thanks, Derek. Appreciate everything. Thanks for inviting me.
We hope you enjoyed our weekly conversation. If you have any questions, comments, or suggested topics, please feel free to connect with either Nitin or myself on nitin@portal.am or derek@portal.am. Feel free to subscribe and share with like-minded friends. Stay well, inquisitive, and engaged. See you next week. Bye for now.